Anyway, talking of financial advice, I don't know where this leaves you. The Bank of England is poised to raise interest rates for the 14th consecutive time today as it fights to take back control of inflation.
Well, signs do suggest that inflation is slowly coming down, with policymakers set to opt for a quarter rather than a half-point rise.
Well, let's talk to our economics and business editor, Liam Halligan, who's here in the studio. Morning to you, Liam. Look...
No good turn goes unpunished.
Oh, that's very good.
That's cynical, but a lawyer once said that to me.
Yeah.
In a negotiation, it's true.
I'll tell you what.
No good turn goes unpunished.
What about my advice, then, about affording something 3 times over? Is it only when you can afford it?
I think shoes and handbags, that's sound advice.
But not for a house.
But not for a house.
Not for a house. No, look, inflation is coming down, right? It was that shock drop last month, 8.7%. It's nowhere near low enough.
It's 7.9 now. We're now at 7.9.
Oh, 7.9.
Which is still almost 4 times the 2% Bank of England target, of course.
But it's heading in the right direction. So why, then, would we see another hike in interest rates?
Well, you're looking at the guy who's been arguing that interest rates should be frozen since March. That's when I started writing that in my Telegraph column, was pilloried for it. But it seems a lot of people are now coming round to that view because inflation is at least going in the right direction. There were a few months there when inflation stayed where it was, which was really quite shocking. Let's have a look at what's happened to interest rates over recent years, Stephen. We have seen so many interest rate rises. Since 2017, you can see there, the line starts moving. We've got the COVID lockdown, interest rates fell to emergency lows. They've since gone up 13 times, they're now at 5%. Now, if you'd have talked to me a month ago, the money markets were predicting we'd see a rise to 5.5%, eventually going to 6.25%, maybe even 6.5%, pummeling a lot of young mortgage holders, particularly those who are having to remortgage off lower rates that they got during that time, whereas you can see on the graph, particularly during lockdown, they did deals when rates were very, very low, 2, 3 and 5 year fixed rate deals. Now, because that inflation number's come down, because inflation in the US has come down, it's now 3%, because inflation in the Eurozone's come down, it's now 5.5%. There's a general sense that we are eventually getting our arms around this inflation problem. Not enough for the Bank of England to not raise interest rates today. I'd say the consensus is we're going to see not a rise to 5.5, but a rise from 5 to 5.25%. That's going to add, a couple of £100 to your average mortgage over the year. So it is still significant. We are now seeing, though, that at least banks with lots of finger wagging from ministers and select committees are starting to pass on some of those rate rises a bit more generously for savers.
It does take a long time, doesn't it, for these interest rates to actually trickle down through the economy, for us to actually feel the effects of them. And that's why there is this argument, including from the IEA this morning, saying, stop, freeze, let those 13 consecutive rises in a row start to take effect, as they already have, and go from there.
There are a few things going on here. Firstly, the banks aren't slow. As soon as there's a rate rise, your mortgage rate goes up. You get an email literally within 24 hours. We've put up your mortgage rate. Whereas if you're a saver, the banks may not pass the interest rate rise on at all. I mean, there are decent savings accounts out there, but a lot of bog-standard savings accounts, they won't pass the rate rise on for months and months and months. Now, what you're getting at, Ellie, and rightly so, is the idea that more broadly, when you raise interest rates, it can take a long time for that to have an impact on the overall economy, even if it impacts individual mortgage holders straight away. And that's true. There was a famous economist back in the 60s and 70s, Milton Friedman, won a Nobel Prize. He says monetary policy, which is moving interest rates around, it only ever works with long and variable lags. And I've been quoting that a lot recently in my Telegraph columns and here on GB News, because when you've already raised interest rates 13 times, you've got all that tightening in the system. That takes time to impact business decisions, investments, inflation, supply chains, all the rest of it. So I personally think, and I've been saying for a while, the bank should hold fire for now. We're right on the brink of a recession in this country. We had 0% growth in May in GDP numbers, as you may remember. So the economy is definitely stalled. You can see that inflation is easing now. So I'd urge the 9 economists on the Bank of England's Monetary Policy Committee, who are in the Bank of England now, and I'll be hot-footing it down there later, to be ready when the decision is announced at 12 noon today. I reckon they should definitely cool their boots and stop raising interest rates and see what happens from now on.
But at what point do they look at this? Do they not look at the wider picture in the sense that this is incredibly damaging to a lot of people? Right, interesting that there's a bit of a conspiracy from Christine. I don't know if she's right or not, but she says, I'm beginning to think the Bank of England interest rate rises are politically motivated to make the Conservatives look bad and verges on a crime against the people. Well, look, I don't necessarily agree with exactly what Christine's saying there, but the idea that it is damaging so many people who are just unable to afford to live in their homes any longer.
Well, I understand where Christine's coming from. We all do, because when you're enduring these interest rate rises, particularly if you've got a mortgage or your kids have got a mortgage and they're struggling, they may even lose their house. Of course, it seems crazy that all these faceless people, and they're barely public people. People know Andrew Bailey a little bit. He's the governor of the Bank of England. But the other 8 members of the Monetary Policy Committee, I'd have to be on good form to name them all. And I'm Liam Halligan from GP News. So these people do seem like faceless bureaucrats. But you know, on the contrary, I'd say that the Bank of England is politically independent. That's what it's there for. But it does still have a reputation, and the governor and the members of the Monetary Policy Committee, they will be aware that they were slow to start raising interest rates. So there will be now, in my view, an element of overcompensation happening, showing that they're really tough and they're going to get rid of inflation. I'm saying that they were too slow at the beginning to start raising rates. They were too cautious at the beginning, back in late 2021, early 2022. And now they're being overly tough in order to try and salvage some of their battered credibility. I think that's definitely going on. And I think Christine should focus on that rather than thinking that the NPC members are deliberately, overtly party political. I don't believe that.
And just briefly on that point, is there any truth in the school of thought that the Bank of England actually want us in a recession to try and tackle soaring prices?
I don't think anyone comes into public life, whether they're a politician or a nerdy economist, because they want to drive people into recession. Almost everybody realises that a recession means, broken businesses, broken homes, broken marriages, broken hearts, really. Recessions are really, really painful. It's when the economy contracts for 2 consecutive quarters. That's some kind of scientific definition. It just means, when the economy goes down, all metrics across society, domestic violence, the economy runs everything. It's the economy, stupid, as Clinton's chief economic advisor once said back in the 90s ahead of an election. So the economy is really, really important to people's well-being and how they feel about life. I don't think anybody deliberately goes into public life to cause a recession. Having said that, Ellie, there is this kind of long history of evidence that sometimes to squeeze inflation out of the system, you have to do things which inadvertently do cause a recession. A recession isn't the point of the policy. The point of the policy is to get rid of inflation. Because in the end, if you have high inflation for a long time, you're going to have a recession anyway, because inflation means people don't want to invest. It means consumers don't want to spend. It means the economy doesn't work properly. It means strikes. It means debilitation. So I would say the Bank of England will probably raise interest rates today. I would say, in my view, personal opinion, it shouldn't. I'd also say if we get a really good inflation number for July, when the numbers come out in the middle of August, then it may turn out that this is the last, fingers crossed, the 14th interest rate rise in this cycle.
Let's hope so. Liam, good to see you. Thanks very much indeed.